main question is contagion, right? Is this just just back a couple weeks and financial system is healthy and it will go away, or is there more distress in the system, right? So the main chart is the 2-year yield, right? And you can turn on the news, and anywhere talks about this concept of disconnect, right? Dissonance between what the Fed is saying, right? Fed raised interest rates by 25 basis points. Inflation is still higher than they would like to see. So continue to raise interest rates. Target rate is at this point is close to 5%, but the 2-year yield is at 3.5%. Was 3.5% this week. So this disconnect, and I like that explanation I heard on TV. This disconnect cannot last very long, right? I mean, maybe a couple weeks, maybe a couple months, but at some point something has to give. Either the Fed will recognize that there are issues in the banking system, and even though inflation is still elevated, they need to start lowering rates, right? To maybe 4% or closer to where the 2-year yield, or vice versa, right? The bond market will realize that there are no issues in the system, or they're well contained, and we have a healthy financial system, and then the 2-year yield goes back to 5%, right? So there, right now, this is one of the main issues, right? Who's right? Is it the bond market is right, and credit default, and the issue is credit default swaps, right? The cost of insuring against the default for banks, or cost of loans, has moved significantly higher, right? So that will impact the earnings of regional banks and global banks, and will create a tighter lending conditions, right? The credit availability will significantly decrease. So that's $1,000,000 question. I posed a question yesterday. I like to do these surveys so we're all on the same page. I mean, there are basically two schools of thoughts, right? The one school of thought that we were in the bear market that kind of ended in October, or reached its peak in October. Inflation is going down, unemployment still remains low, China is reopening, everybody's traveling. We've seen services PMI today. People are still high, people are spending, services market is good, and this is just the bull market has resumed, right? So not in the same line, but something like this, right? Something along those lines. So scenario number one, we're in bull market, right? The bull market has resumed, right? Some of the asset classes are up more than 20% from the bottom, right? Some of the technology, Nvidia, Microsoft, Coinbase, and Arc Innovation, Tesla, they're more, up more than 20%. So by definition, we are in the bull market since October. Right? So scenario number one, bull market. It's been 6 months since we've seen the lows, right? So that means, a lot of people think these are the lows, right? Scenario number two, the issues that we have seen in the past 2 weeks. This is just the beginning of the credit issues, and maybe we're not going to have 2008. Right? Hopefully we're not, but most people think we're not going to have 2008. But this is not this is not the end, right? Now we have issues with Deutsche Bank in Germany, and tomorrow it'll be Greece or Spain or something along those lines. And then the scenario number two, we're kind of slowly grinding lower, and this is not the low, right? So why is this important? I personally think that it's very hard to trade, or at least invest, like longer term, unless you have an opinion on the market, right? And so the one scenario, you're bull, you think we're in a bull market, and the second scenario, this was just a kind of a little break, 6 months break from the bear market, and now bear market has resumed, right? Which by definition will be down more than 20% from the recent highs. So that's a question. A lot of people say, listen, you have to be nimble, you have to be flexible, data dependent. You know, you could be a bear today and bull tomorrow. I think it's very, for me personally, it's very hard to trade, right? If I have to change my opinion every week or even every month, right, or even every quarter, right? And especially longer term trades where you hold them for months or a couple months, very difficult, right? Because usually you have a view and you just trade based on the view with the realization that market doesn't move one way, but is this a pattern of lower highs, lower lows, or is this a pattern of higher highs, higher lows, right? That's the difference. So that's the $1 million question, right? So that's what everybody's debating, right? I do agree you have to be flexible and data dependent. I mean, if you're a bull 2 weeks ago, you probably want to think about it, whether you want to remain the bull or how bullish do you want to be. When market broke, when we broke through December highs, right, I had to scratch my head and decide, do I want to be a bear, right? Like, why is all of a sudden we have 6 months break from the bear market? So you need to get back to the whiteboard. You need to be flexible, but nonetheless, your opinion is important and the view on the market is important, at least, going to the end of this year. So let's go through the room and just say, you think, are we in the bull market and bull market has resumed, or are we in the bear market and the bear market just took a little break?